In fact, we've got Ed Yardeni joining in on the show right now to talk about exactly that. Ed, hi, morning. Good to have you on the show. And seems like a lot of uncertainty in the world is dissipating. But is it too soon to actually assume that all's well and it can't get better than this?
Well, I agree with you that the market has, in a matter of weeks, moved from lots of things to worry about to suddenly maybe nothing to worry about. Even on the geopolitical front, there seems to be a lot of potential ceasefires going on, even a potential ceasefire between India and Pakistan, between the United States and the Houthis, between Russia and Ukraine. These are all tentative, but it certainly suggests that things are moving towards a more peaceful, diplomatic and negotiating approach to dealing with world problems. And here in the United States, I think the odds of a recession have gone down now that Trump's trade war seems to be simmering down. And now that we have not only 90 days through July 8th for negotiating with every country around the world except China, and now we have 90 days, I guess, from today on negotiating with China with certainly lower tariffs than we had at the beginning, at the end of last week. So all in all, it looks pretty good, and there just seems to be a tremendous amount of buying power. Some of it may be short covering, but I think a lot of it is FOMO, fear of missing out. And the fundamentals are probably going to look better and better as we get approach 2026.
So Ed, what could be the next big trigger for equity markets to go higher? Could it be Fed? Could it be American earnings? What could be that next big trigger?
Yeah, I don't think it's going to be the Fed. I think, if anything, the Fed is going to remain on hold for longer. There's no particular reason for the Fed to lower rates if the labor market remains resilient, which it has, even as the trade war got started. Now that the trade war is easing off, I would expect that the labor market would remain relatively robust. Yeah, I think it is going to be earnings. I think it is going to be the resilience of the economy. I think the U.S. consumer is going to continue to spend. I think capital spending, which everyone thought would be very weak because of uncertainties, I think capital spending on technology seems to be quite resilient as well. The data center spending has a lot to do with the demand for cloud computing, and cloud computing demand is only increasing. And of course, we're rapidly approaching the age of humanoid robotics, autonomous driving. These are no longer theories. They're no longer toys. They're actually going to be items that influence our lives dramatically. So I today, as a matter of fact, raised my outlook for the S&P 500 back up from 6,000 to 6,500 by year end. And I also lowered my odds of a recession from 35% to 25%. The remaining 75% I would characterize as a potential for a roaring 2020 scenario. And so I'm picking up on that theory of mine, that thesis of mine, which I've held since the beginning of the decade.
All right, Ed, really appreciate your time. Thank you for joining us.
If you like this video, then like, share and subscribe to ET Now.